Inflation is usually presented as an unfortunate side effect of a growing economy. Prices rise, wages eventually catch up, central banks step in, and life moves on. At least, that's the story most people are taught. It sounds reasonable. It sounds temporary. It sounds like a problem that simply has to be managed. The only problem is that history tells a much darker story. Because inflation has often been far more than an economic accident. Time and again, governments buried beneath mountains of debt discovered that reducing the value of money was politically easier than reducing the debt itself. The loans remained. The promises remained. What changed was the purchasing power of the currency used to repay them. Britain did it. France did it. Germany did it. Argentina did it. Different governments. Different centuries. Different political systems. Yet the underlying mechanism barely changed. Whenever debt became too large to confront directly, the value of money quietly became part of the solution. Many economists argue that the United States is now moving through a remarkably similar pattern. Not because history repeats itself perfectly, but because governments facing overwhelming debt tend to reach for the same tools. The language changes. The institutions change. The circumstances change. The financial logic rarely does. This is the story of how governments make debts seem to disappear. Not by paying it off, not by refusing to honor it, but by changing what that money is actually worth. This is Crash Historian, where history uncovers the hidden forces shaping money, power, and the modern world. If you enjoy documentaries that uncover the hidden mechanics behind economics and history, consider subscribing. And let me know what city you're watching from. I'm always curious to see how far these stories travel. To understand how this works, we have to begin with a simple question. What happens when a government owes far more money than it can realistically repay? Default is politically disastrous. Higher taxes are deeply unpopular. Spending cuts carry enormous consequences. So history shows that many governments have chosen a quieter path. Instead of reducing the debt, they reduce the value of the money used to repay it. The numbers never change. A government that owes $100,000 still repays $100,000. On paper, every promise has been kept. In practice, those dollars buy far less than they once did, leaving the lenders with money that has lost much of its real value. That is the strategy. No dramatic default. No public declaration of failure. Just a currency that gradually loses purchasing power until the real burden of the debt becomes far smaller than it once appeared. Economists call this financial repression. For more than 2 centuries, it has remained one of the most reliable ways heavily indebted governments reduce the real value of what they owe without openly admitting failure or accepting the political costs that usually accompany a sovereign default. If this sounds like little more than an economic theory, history offers a useful reality check. Because this pattern has played out before, across different countries, under different governments, and in very different circumstances. The details changed, but the underlying logic remained remarkably consistent. Britain provides one of the clearest examples. After the Napoleonic Wars, the country's national debt had climbed to nearly 200% of its entire economy. Decades of financing war had left Britain with obligations that could not realistically be paid down through taxation alone. The government needed a solution, but an outright default would have been politically and financially disastrous. So it chose a quieter path. Interest rates were kept artificially low for decades, inflation was allowed to run, and the real value of that debt gradually declined over time. Nothing disappeared overnight. The process unfolded slowly, almost quietly, across much of the 19th century. But by the end of it, the burden of that enormous debt had been dramatically reduced. France followed a remarkably similar pattern. Throughout the 19th and 20th centuries, the franc was repeatedly devalued as successive governments searched for ways to ease the weight of their financial obligations. Every devaluation made existing debt easier to carry, but it also carried a hidden cost. The burden wasn't eliminated. It was transferred to the people holding French currency, whose savings quietly lost purchasing power along the way. Germany's story represents the most extreme version of the same idea. After the First World War, the burden of reparations became so overwhelming that the government resorted to printing money on an extraordinary scale. The result was one of history's most infamous episodes of hyperinflation. The currency collapsed, prices spiraled out of control, and the images that survived, people pushing wheelbarrows full of cash just to buy a loaf of bread, became symbols of an economy in complete breakdown. That, however, is the version everyone remembers because it failed so spectacularly. It is the chaotic end of the process, not the preferred one. Most governments are not trying to destroy their currency. They are trying to weaken it just enough that debt becomes easier to repay, while the process remains gradual enough that most people never recognize what's happening until the value has already been lost. The version that truly matters, however, isn't the one that ended in collapse. It's the version that worked. The one that succeeded quietly, lasted for decades, and became a model that would be studied and repeated long after the Second World War had ended. If there's a blueprint for understanding what many economists see unfolding today, this is where it begins. In 1945, America's public debt stood at roughly 106% of the entire economy. The war had been financed largely through borrowing, with government bonds sold to ordinary citizens, banks, and financial institutions. The war had been won, but the financial burden remained. The Treasury was left with an enormous debt and very few politically acceptable ways to reduce it. Raising taxes enough to pay that debt down was never a realistic option. The country had just endured the Great Depression, followed immediately by a global war. Public support for another round of sacrifice simply wasn't there. So policymakers chose a different approach, one that attracted far less attention. The Federal Reserve agreed to cap the yield on government bonds at 2.5%. That rate wasn't determined by free market forces or investor demand. It was maintained because the government needed borrowing costs to remain low. Whenever bond yields threatened to move higher, the Federal Reserve stepped into the market, bought government bonds, pushed their prices upward, and forced those yields back down. At the same time, another change was taking place. Wartime price controls, which had kept prices artificially low throughout the conflict, were gradually removed. As those controls disappeared, prices rose sharply. Between 1946 and 1951, inflation averaged more than 6% per year. That combination changed everything. A government bond paying 2.5%, while inflation runs above 6%, loses purchasing power every single year. In other words, the investor receives their interest, but the money they get back buys less than the money they originally lent. Economists describe this as a negative real return. In practical terms, it represents a quiet transfer of wealth from the people financing the government's debt to the government itself. Notice what didn't happen. The debt wasn't dramatically paid off. The government didn't suddenly erase what it owed. The number of dollars remained largely the same. What changed was the value of those dollars. As inflation steadily reduced their purchasing power, the real burden of the debt became smaller and smaller. The results appeared remarkably quickly. By 1948, only 3 years after the war had ended, America's debt-to-GDP ratio had already fallen from 106% to 92%. That improvement wasn't driven by paying back 14 percentage points of debt. It happened because inflation quietly reduced the real value of those obligations while interest rates remained artificially restrained. More importantly, this wasn't a temporary policy. It didn't last for a year or two before disappearing. Variations of the same approach continued for decades. Between 1945 and 1980, the average real return on U.S. government bonds remained negative. For roughly 35 consecutive years, investors holding government debt steadily lost purchasing power, even while receiving every dollar they had been promised. The obvious question is why anyone accepted those terms. The answer is surprisingly simple. For many of the largest investors, there were very few alternatives. Pension funds, insurance companies, and banks were required to hold substantial amounts of government debt because it was considered the safest asset available. Corporate bonds carried greater risk. Stocks were too volatile for conservative institutional portfolios. Investing overseas introduced currency risk, capital controls, and a long list of additional uncertainties. As a result, those institutions continued buying government bonds even though the returns were negative after inflation. They weren't doing so because the investment was attractive. They were doing so because the alternatives were either more dangerous or simply unavailable. That is financial repression in its most complete form. It isn't simply about inflation. It's about inflation combined with a captive group of buyers who have little practical choice but to continue financing the government's debt, even as the real value of their savings steadily declines. The long-term results were extraordinary. America's debt-to-GDP ratio fell from more than 100% in the mid-1940s to roughly 23% by 1974, an overall decline of approximately 83 percentage points. Where did that improvement come from? Government budget surpluses accounted for roughly 35 percentage points. Economic growth contributed another 32. And negative real interest rates, the inflation tax quietly imposed on every bondholder, reduced the debt burden by nearly 16 percentage points on their own. Remove that final piece, and the picture looks very different. Instead of falling to roughly 23% of GDP, America's debt would have remained closer to 74%. The debt was reduced through growth, through fiscal policy, and through inflation, but financial repression alone accounted for almost 1/5 of the entire adjustment. Now bring that same playbook into the present, because the similarities are difficult to ignore. America's debt-to-GDP ratio now sits at roughly 120%, already higher than the post-war peak that gave rise to this strategy in the first place. At the same time, interest payments alone are approaching $1 trillion a year, making them the second largest expense in the entire federal budget. The important point, however, is that today's America is not the America of 1946. The similarities matter, but so do the differences, because they determine whether the same strategy can succeed again. After the Second World War, the United States had one enormous advantage: demographics. Millions of soldiers returned home, families expanded, the labor force grew rapidly, and a younger population generated rising tax revenues without the government having to increase tax rates. Economic growth was not something policymakers had to manufacture. It arrived almost naturally. Today's picture looks very different. The population is aging, while programs like Social Security and Medicare now consume roughly 2/3 of the federal budget. That share continues to rise automatically as more Americans retire, leaving policymakers with far less room to generate the kind of sustained budget surpluses that helped reduce debt after the war. The 35 percentage points of debt reduction that came from fiscal surpluses in the post-war period are, under today's conditions, politically and mathematically far more difficult to achieve. That leaves economic growth and inflation carrying much more of the burden. And once you recognize that, the mechanics of recent years begin to look surprisingly familiar. During the pandemic, the Federal Reserve purchased trillions of dollars in government debt, holding interest rates near zero even as federal borrowing expanded at an unprecedented pace. The effect was straightforward. The government could finance enormous deficits while keeping its interest costs artificially low. At first, inflation appeared relatively contained. Throughout 2020 and much of 2021, the Federal Reserve repeatedly described the rise in prices as transitory, suggesting it would fade as the economy normalized. Instead, inflation accelerated dramatically. By 2022, it had reached roughly 9%, the highest level seen in 4 decades. That combination created exactly the same financial dynamic that existed after the Second World War. Anyone holding a government bond paying 1% interest while inflation was running at 9% was losing approximately 8% of their purchasing power every year. Economists call that a negative real return. The government still repaid every dollar it owed, but those dollars were worth considerably less than when they had originally been borrowed. Between 2020 and 2023, cumulative inflation exceeded 20%, while much of the government's outstanding debt continued paying interest rates below 3%. The result was predictable. Bondholders lost a substantial share of their purchasing power, while the real burden of the government's debt declined, not because the debt had been repaid, but because inflation steadily eroded its value. Now consider the Federal Reserve's position today. After raising interest rates aggressively to bring inflation under control, policymakers have also shown clear hesitation about pushing rates much higher, even as inflation remains above their long-term target. Officially, the explanation centers on balancing inflation, economic growth, and employment. But there is another constraint that receives far less attention. Every additional percentage point added to interest rates increases the federal government's annual interest cost by hundreds of billions of dollars. Sustaining genuinely high real interest rates for an extended period would make servicing the national debt dramatically more expensive and could place severe pressure on the government's finances. As a result, policymakers are attempting a delicate balancing act. Interest rates must remain high enough to demonstrate a commitment to controlling inflation, yet not so high that government borrowing becomes prohibitively expensive. That narrow space, where inflation runs slightly above interest rates, is precisely the environment in which negative real returns quietly reduce the real value of outstanding debt over time. Japan offers a glimpse of where that path can eventually lead. For years, Japanese policymakers have openly capped government bond yields even as the country's debt climbed beyond 250% of GDP. The Bank of Japan now owns more than 40% of all outstanding Japanese government bonds, illustrating just how closely monetary policy and government finance can become intertwined. The United States has not reached that point, but the fiscal pressures facing both countries point in a remarkably similar direction. There is, however, an important complication. The strategy that proved so effective after 1945 depended on a unique combination of circumstances: a young and expanding workforce, strong economic growth, a financial system filled with institutional investors that had few alternatives to government bonds, and a population willing to accept years of gradual adjustment after living through depression and war. Several of those conditions no longer exist. An aging population makes sustained growth more difficult. Roughly 30% of U.S. government debt is held by foreign governments and overseas investors, including countries such as Japan and China. Unlike domestic institutions, those investors are under no obligation to continue accepting negative real returns indefinitely. They have other options, including different currencies, gold, and a growing range of alternative assets. If those foreign investors begin reducing their holdings in a meaningful way, the Treasury faces an increasingly uncomfortable choice. It can offer higher interest rates to attract new buyers, increasing the government's borrowing costs and undermining the strategy itself. Or it can rely more heavily on the Federal Reserve to purchase government debt directly, moving one step closer to outright monetary financing and further weakening confidence in the currency. For now, the dollar still benefits from its role as the world's primary reserve currency. A large share of international trade continues to be conducted in dollars, creating consistent global demand for U.S. government debt even when returns are relatively unattractive. But even that advantage has begun to narrow. 2 decades ago, the dollar accounted for roughly 70% of global foreign exchange reserves. Today, that figure has fallen to around 60%, a gradual shift, but one that suggests the margin for error is becoming smaller than it once was. So where does all of this leave us? More importantly, what does history actually suggest we should take away from it? The first conclusion is the simplest. This isn't a conspiracy, and it isn't some obscure economic theory. It's a documented mechanism that has appeared repeatedly throughout modern history. Britain relied on it. France relied on it. The United States relied on it after the Second World War. And many economists argue that elements of the same pattern can be seen again today in the combination of elevated inflation and interest rates that struggle to stay meaningfully above it. The Federal Reserve doesn't describe its policies in those terms, nor would you expect it to. The language is different. Policymakers talk about monetary policy, financial conditions, inflation targets, and economic stability. Economists debate concepts like yield curve control and negative real interest rates. But across 2 centuries of financial history, the underlying mechanism has remained remarkably familiar. The debt doesn't disappear because it is repaid more quickly. It disappears because the money used to repay it gradually becomes worth less. The burden doesn't vanish. It moves, quietly, slowly, and almost invisibly from the government's balance sheet to the people and institutions holding that currency. Not all at once, but one inflation report, one bond auction, and 1 year at a time. Whether the same strategy succeeds as smoothly today as it did between 1946 and 1980 is a very different question. This time, the outcome depends on forces that no central bank fully controls: an aging population, the willingness of foreign creditors to continue financing American debt, and the durability of the dollar's position as the world's primary reserve currency. History doesn't guarantee the same ending. The conditions are different, the global economy is different, and the constraints are different. But the mechanism itself is neither new nor particularly mysterious. Once you understand how it has worked before, it becomes much easier to recognize the pattern when it begins to emerge again. It is, in many respects, the same solution that governments have returned to repeatedly over the past 2 centuries. Different countries, different crises, different institutions. Yet the underlying financial logic remains strikingly familiar. And if history is any guide, it may be unfolding once again in the currency that many of us use every single day. If you enjoyed this deep dive into the hidden mechanics of money, debt, and history, subscribe to Crash Historian. Every week, we explore the financial decisions that shape nations, transform economies, and continue to influence the world today. Until next time.